news for the new year. Treasury Secretary Janet Yellen has declared a soft landing recession. Of course, in 2017, she said she did not believe there would be a financial crisis in her lifetime. Considering the fact that it is her job to keep the public calm so they hold their wealth in the fiat money products and system. Frankly, that enables central bank theft through various forms of inflation and rule changes and manipulations. But a spike in interest rate impacts the ability to borrow. And a Fed pivot drop in rates would indicate a financial crisis is underway. A drop in rates and more money printing is inflationary. And quite honestly, the recession has not fully hit yet. It's important that you understand the risks in the Treasury market, since the 10-year Treasury is the foundation of the global financial system. But those in authority intentionally hide these dangers. I'm going to show them to you. Coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer specializing in custom strategies that are based on the life cycle of a currency, of any currency. And we are at the end of ours, so let me show you what's happening. Because now, forget rates, now worry about the Fed unwinding its balance sheet, which means the Federal Reserve selling $95 billion worth of treasuries and mortgage-backed, mostly treasuries, but treasuries and mortgage-backed securities a month. Discussions come as funding markets showing signs of angst. Wow, okay, do you remember 2019? Because I sure do. They tried an unwind before. The last time the Fed attempted a balance sheet reduction in 2019 in the funding markets prompted a rethink. You think? Of course, because Fed printing is all they have. That's the only tool that they have. And so that is what's creating artificial liquidity in the markets. And when you take that away, there is no liquidity. So that's what happened in 2019. And you can see that this is where they are dropping their balance sheet. Now, they're still very close to 8 trillion in holdings on their balance sheet. But look at this. These are the deposits held by depository institutions. So those are going up a little bit because I guess March last year wasn't a big enough of a warning to say, don't keep your money in the banks. So, okay, let's forget that. I'm getting more interest, so risk your principal. Makes no sense to me. The Treasury account itself is up, but what's down? Reverse repos, right? And the reverse repos are the collateral. The Treasuries, rather, are the collateral for this repo market, which is the underlying plumbing of the global economy. And a lot of that also comes from money market accounts, which most people think are so safe. Well, are they? I think it bears a rethink. Because right now, with what the Fed is doing, repo's era of calm is over as Fed pullback reignites volatility. They are between a rock and a hard place. If they do one, that creates this problem. If they keep rates high with this massive mountain of debt that is getting rolled over and government debt that is being issued, that means that's a lot more expensive. It's a problem. If they turn around, or I should say when they turn around and drop those rates down, then you've got free money again, money printing, and you've got inflation coming back. Now, will that force them then to raise rates again? They're between a rock and a hard place. It doesn't really matter what they do. We are at the end of this currency's life cycle. So overnight, general collateral repo traded as high as 5.6% just on December 28th. Look at that. So interest rates are going up. And what happened in 2019 and what potentially could be happening now is the Fed could be losing control of interest rates because they handed over trading to the markets. Traders don't give a crap about any of that. They just care about making a little bit of money. That's all. So what they're really doing is solving one problem, but then they're setting up the next problem. Which one will be the last straw? I'm going to be as surprised as you are when it happens, but I'm going to be prepared because I have my gold, my silver, my food, my water, energy, security, barterability, wealth preservation, community, and shelter. I'm hoping that you have prepared likewise. Otherwise, community becomes the single most important thing because you're going to be dependent upon a whole, well, I am too, dependent upon a whole bunch of people to bring their skills together to help us survive this mess. But interest rates can be volatile, so let's just look at this. Now, I had a question last week on the SOFR raises to fresh all-time highs, and what about the LIBOR? And what I've said is, it ain't over yet. What they like, and they say it in all their writing, is that they want distance between their policy and however that policy shows up to the public so that you don't understand that what they did over here is impacting what's happening to you over here. Let me show you, give me a minute and I'm going to show you this because back in 2019, that was the spike in the SOFR rate. Central bankers in 2019 learned a lesson when a different overnight market rate soared fivefold as high as 10%, and the central bank was forced to intervene. This is all a Ponzi scheme. They need to keep new money coming in, but the problem is that the debt levels are so high, whether you're a government, a corporation, or an individual, that it's challenging to grow more debt, especially in a higher interest rate environment. They have painted themselves into a corner. Absolutely no doubt about that. The return of these violent swings is largely thanks to the Federal Reserve, which is removing liquidity from the system via quantitative tightening, or QT. Run off a balance sheet, raising rates, that's what creates that QT. It's finally happening. With months of balance sheet runoff and massive Treasury issuance, we are at a point when supply is creating more volatility in the markets. I think 24-25 will have the volatility of 2018, 2019. So what are they doing behind the scenes to answer that question that was asked last week? Let's look at this repo market overview because it's important for you to understand it, especially if you're holding any of your wealth in money markets, right? And it doesn't really matter whether what I'm about to say, whether they're corporate or they're government. SOFR, which is the new benchmark rate created, reflects transactions in the Treasury repo market. Repos are conceptually straightforward, just conceptually straightforward. They effectively are collateralized loans, in many ways similar to mortgages in which homeowners borrow money using their homes as collateral. And in the Treasury repo market, people borrow money using Treasury debt as collateral. But because the SOFR really, those rates are different, and that creates a tectonic shift in valuation. Remember, interest rates go up, market values go down. Interest rates go down, market values go up. So we've been dealing with interest rates up, market value down, right? But the SOFR rate does not reflect the LIBOR rate. There are still, but the contract's valuations are based on the LIBOR rate. So let me show you what they did and why you have not seen the explosion yet and why I'm saying to you, it ain't over. Okay. And that's because the transition away from LIBOR really hasn't happened. Here's the SOFR average, last 30 days, 90 days, and 180 days. Here's the LIBOR rate. They call this a synthetic rate. They're both synthetic. It's just garbage. It's just wordsmithing. But these are significantly different than this. So what they do is create a fallback spread. They add it to this so that you don't see this big fluctuation in the principal value of all of this debt. Because it doesn't just have to be bonds. It can be mortgages. It can be anything, because we are a debt-based system now. All assets are going to respond to this based on these interest rates. And with the Fed, that's why they attempted to raise those rates, to give them room to drop them again and stimulate by enabling entities, whether they're governments, corporations, or individuals, to borrow more money. But we have been having a problem with liquidity in the Treasury market that first started showing up in 2015. And now we have a liquidity alert. Pay attention to this because it impacts you and your ability, if you've got debt, your ability to pay that debt off. If you want to take, if you got credit card debt, what you're going to pay in interest. You've got to understand what's going on. Fed's balance sheet leaps into spotlight after repo volatility because their attempt to run off the balance sheet led to the 2019 crisis. Now, they covered that up really quickly like they try and do, just what they did last March when the banks started to implode. They covered up really quickly, nothing here to see, just keep moving, just keep your money in the system so that when they finally bail in all of the debt-based assets, what are you going to do about it? You want to be preemptive. That's the point of gold for wealth preservation. This is what I use for my personal wealth preservation because it's out of the system. It's real. It has more functionality than any other asset class, and it runs no counterparty risk. Everything else is all counterparty risk. Okay. So the use of reverse repo facility fell by $313.6 billion on Tuesday. Traders look to this tool for clues on the quantitative tightening path. You gotta pay attention to this stuff. So this is the use of the Fed's RRP, reverse repo facility, fell, and look at how far down it's gone, and look at when it started to come up. It is down at 1 trillion from well above 2 trillion. Okay, you say, well, isn't that okay? Well, maybe, but Wall Street strategists have estimated balances at the RRP facility will be completely depleted by the end of the second quarter, at which point, this is important, at which point the central bank will be compelled to halt quantitative tightening. In other words, they will not be able to run off their balance sheet anymore. And what happened in 2019, and that forced the Fed to go back in and boom, stimulate, there's your hyperinflation. And we've already seen that that's begun in the monetary velocity that I just showed you, I believe it was last week. The third largest right now is the third largest start of the year outflow since the facility was introduced in, when was that? 2013. And what did we see in 2013? I didn't put that graph in this one. I've used it so many times. But you look at the volatility on the 10-year Treasury, and that's when it is quite clear that the Federal Reserve handed over control of that market to traders that are just looking to make a little bit of money. They don't care about the stability of the markets. But if your foundation, if you're in a house and your foundation is moving like this, are you going to stay in that house? Or are you going to get out? So what I'm telling you is the foundation of the global monetary system is doing this. It's doing this. You going to stay in it? Up to you. As long as you have wealth preservation, you have a properly diversified portfolio, it's up to you. Do I have anything in these markets? No, I don't. Do I care that I've missed these rallies? No, I don't. Because I'm quite comfortable and I sleep very well at night because this is what I own. You do whatever you want. It says something that you have the greatest volatility even in inflows and outflows. That's telling you something. Are you going to listen to what the markets are telling you? They're telling you, get out. But the problem is this stuff too? It's based on treasuries, the government. What backs it? The full faith and credit, right? So as long as you trust them, you'll continue to loan money to the government. What happens when you don't trust them? Actually, you know what happens? I'll do it with this one because it's bent. This is what happens. It has absolutely zero value. No value. It really has no value right now, even officially, only 3 cents. But you do what you want. I know what I'm doing. The Fed will have to stop its balance sheet runoff before the reverse repo facility is entirely drained. At the same time, that money market fund assets rise to new all-time highs. So, you're running into the chicken coop and the foxes are holding the door open and they've got a whole band of foxes in there. I'm telling you, as a chicken, I'm running to the safety of gold. I'm not running into the chicken coop, but a lot of people are. Total climbed to 5.965 trillion. And the sad part is people think that these are safe. But there were a number of people in 2008 that learned that money markets are not so safe. So they changed the rules, making it harder for you to liquidate your money markets. That was the solution. And they drained a lot that was going to corporations. The government drained it into prime accounts that have government debt on there. But that's the public. We already know, I've done videos on this recently, where the long-term holders that don't really care about price fluctuation are getting out of the market, including the Federal Reserve. That's what we're talking about here today. And the public is getting in. Voila. That's what we're talking about here today as well. And you can see this goes back to 2020 with the big spike into interest rates. But government funds, which invest primarily in securities like Treasury bills, repurchase agreements, and agency debt, saw assets rise to 4.878 trillion. So you think you're safe in government funds? You know, there is this bridge in Brooklyn that I'd love to sell you. Because you believe this, you're going to believe that. But I'm going to tell you the truth because I actually don't really own a bridge in Brooklyn. Although my father was born there in Canarsie. Okay, so the markets in general sees the Fed's exit from quantitative tightening nearing, which is why you see interest rates dropping down and therefore short-term bond values, market values going up. That's why you see the markets. Markets have been very volatile, but the markets have been going up. The problem is that all of those pieces of Wall Street intangible crap is all based on this. Well, this is my funny money, but basically based on dollars that are also losing value via inflation. You're experiencing inflation. Is that because those things that you're buying are worth that much more? Or that the dollar is worth that much less? That's what it's about. And that's the only thing they have that at their disposal, right? So now, hey, interest rates are up, 5.5%. The Fed has room to drop them down. So they broke the broken market that they created. And then they're going to go bail it out again? Well, it only works so many times. Volatility has erupted again. Gyrations in repo rates sent one benchmark to a record in the past week, while the market for short-term loans collateralized by treasuries fluctuated, which means went up and down, up and down, up and down because of that volatility. In fact, volatility in short-term funding markets can hinder central bankers' ability to manage monetary policy. Oh my goodness. Don't worry, we'll let them bring out the CBDCs, the central bank digital currencies, and what do they say? We can have our finger on that button 24/7. You are going to be so off balance with anything they're doing unless you have food, water, energy, security, barterability, wealth preservation, community, and shelter. You need to get those things locked in. Answer this question for yourself. Do you want the central banks to have the ability to just at will? I don't. I want to be able to say to them, too bad, so sad. What you do, yeah, it's going to impact everybody. I'm not going to be immune, but I'm going to be more immune because I have especially the only financial asset that is completely outside of the system and runs no counterparty risk. None. But do you think all of this volatility and potentially those massive, higher than they can expect, interest rate spikes, will that force that Fed pivot that the markets are demanding? Who do you think is stronger, the central banks or Wall Street? I guess we're going to find out, aren't we? And all of this, is that why gold is breaking out? And I'm talking about spot. I'm not talking about the real thing. That broke out a while ago. So let's look at this spot market because remember, we've talked about these different toppings, right? 1, 2, 3. 3 tops. A fourth is 3 is a lot, right? Where it goes up, it hits its head, and then it comes back down, goes up, hits its head. So that's what they're attempting right now, is to further push it down. But the way that it works is really simple. When you have a spring, and that spring is held down, so the spot price on gold is held down. When that's released, it shoots in a direction. And that's what it's been doing. And I would consider this, now this I would not say is a pervasive breakout yet, but I would say that that is imminent. So this is probably your best and least expensive time to position into this. Therefore, in this year, I expect much higher spot gold prices. And no matter what happens with spot gold, because remember, a rise in gold price is an indication of a failing currency. And so it benefits central bankers and those that are in power to suppress that spot price. But in the physical only, this is physical only market, we have seen at the upper echelons making way new highs. And even in the area that I personally buy into, still making this trend new highs. Get your positions built while you still have the opportunity. And make sure that you're paying very close attention and watch our latest videos, understanding how governments and banks hide the economic realities. Daniela just did an interview with a very good friend of mine, Gerald Celente. You guys know I love him. He's been on my channel many, many times. He's certainly one of the most entertaining people that I know, that's for sure. And Taylor did BRICS one step closer to wiping out the US dollar. So there's a lot of information. We are all about education, and we've really built quite a strong desk If you haven't done this yet, make sure you click that Calendly link below and start your own gold and silver strategy. You can do it at your convenience. So you can either call us or you can set it up online. Make sure, if you haven't already, make sure you subscribe. Leave us a comment, give us a thumbs up, and until next we meet, please be safe out there. Bye-bye.